Good afternoon to our audience, wherever you may be. We are gathered here today for this Observer Research Foundation Roundtable on digital payments. And we have a very august gathering of participants and speakers. I would just like to start by saying that obviously we are able to discuss digital payments and continue to work as usual, even in the context, in the unfortunate context of what we've witnessed over the last 48 hours. The news cycle um, has been particularly disturbing, and I think all of us stand in solidarity with our armed forces, and we are only able to continue to be in business as usual mode because of the supreme sacrifices made by those at the border. With that, I would like to just run through the list of speakers in the order that I will introduce them and bring them into the discussion today. Shivangi Mittal, who's an associate and an economist at Koan Advisory, will be presenting the opening presentation of 5 or 7 slides to set the larger macro context within which we find ourselves and this discussion. We will then move on to Sunil Abraham, who's a professor for digital policy and design practices at the University for Arts at the Netherlands, and he's the former founder for the center and is the founder of the Center for Internet and Society. We will then move on to Ms. Malavika Raghavan, who's the head of the Future of Finance Initiative at Dvara Research, which is a specialized policy think tank. We will move on to Mr. Ashutosh Chadha, who's the Vice President for Public Policy at Mastercard India. And then over to Mr. Vishal Mehta, who's the Head of Strategic Partnerships and Payments for the Asia Pacific region at Microsoft. And then finally, we will end with the first round with Mr. Ajit Pai, who's a Senior Advisor for Financial Services and Officer on Special Duty at the NITI Aayog. I may have got bits of that wrong because his role is evolving even as we speak. So without taking too much of your time, I would just like to situate this discussion within the larger framework or agenda for this today, which is we are here to attempt at a difficult time for the Indian economy as well, which is struggling through and is in the throes of this pandemic, struggling through both demand and supply side disruption. So this is a unique crisis in many ways, where both the ends of the spectrum on the market side are impacted. And obviously digital payments is a method or a tool that can help enable demand and unlock demand wherever it is artificially suppressed. And we hopefully will see some of that in the trends that Shivangi will talk us through. So the agenda here really is to look at low-hanging fruit for the digital payments ecosystem to be unfettered, to create larger value, to drive this demand further that can revive economic growth in India in the short to medium run. And with that view, we want to focus our remarks, our recommendations towards the end, many of which we hope to capture in written form, on areas that don't necessarily require some great institutional overhaul, a legislative amendment, and so on, but areas that we can easily start to pick out that through notices, orders, small changes in business practices or policy practices or supervisory practices, as the case may be. So with that context, I would hand over to Shivangi to just run us through a quick overview of what the payments ecosystem looks like today.
Hello, everyone, and thank you for the opportunity to participate in this discussion today. I will today talk you through some trends in digital payments during the COVID-19 pandemic in India, and I'll be focusing on the 4 months that have passed since the beginning of this year. I'll start with stating that digital payments in India serve diverse needs, and both of merchants and of the end users or the consumers, so to speak. Merchants in India are, so the large majority of merchants in India are MSMEs, and even within MSMEs, the largest fraction, over 90%, is of micro merchants. And these micro merchants also form over 90% of India's retail market overall. This also maps to the sources of income for India's labor force, where we see that a large majority of households, especially rural households in India, are self-employed. And amongst users, we see disparities on the basis of gender, income, and geography. For instance, here I've included the differences in the male and the female literacy rates in urban and rural areas. And of course, these inform the socioeconomic context in which people use digital payments, and their ability and their awareness about these instruments. That said, India was already in the midst of an economic slowdown before the coronavirus pandemic hit us. And transactions are very closely correlated with economic activity. So for example, if fewer businesses are running in the economy, fewer transactions to pay employee salaries will be made. And of course, digital payment transactions are only a subset of the total transactions in the economy. Here I've included FASTag as an example of the impact that the lockdown had on transactions. So we see a very sharp decline in the number of FASTag transactions in the month of April, which is when mobility restrictions were at their strictest, and some states had even restricted the movement of essential goods across their borders. Like I said earlier, the decline and the slowdown in digital payments and transactions overall was evident in India even before the pandemic hit. So in this table, we can see that the value of transactions in both cash and digital payments had started declining in February, in some cases even in January. And there are two noteworthy trends even amongst these macro trends, so to speak. The first is that the growth of digital payments transactions, their value was almost 30% in the month of March 2020. And this is possibly because the lockdown and even the pandemic hit India only in the last days of the month, and and this high growth could possibly be end of the year transactions that many businesses had processed as a routine matter before these restrictions were imposed and relaxations were given on these end of the year transactions. And second, we see that cash withdrawals and digital payments declined by almost the same magnitude in the month of April 2020. However, the cash in circulation in the first 4 months in the economy was already higher in 2020 than the overall, than the total cash in circulation in 2019. So this can be interpreted as a risk-averse flight to cash in these times of uncertainty. If we look at digital transactions more closely, we see that although the total number of digital transactions fell during April 2020, the number of non-financial transactions actually increased. And I think that this could be due to two reasons. One is that people started exploring online methods, and even banks started providing these facilities of finishing paperwork online, which otherwise could have been done offline by visiting bank branches. And the second the second reason that this trend exists is that a lot of people in rural and remote areas onboarded themselves onto platforms like APAC using ATMs, which are included as non-financial digital transactions here, so that they could access the direct benefit transfers that they received as compensation for the lockdown. The other behavioral shift that we saw during the pandemic and especially during the lockdown is that both users and merchants realize the value of using digital payments. And for consumers, using digital payments meant safety, convenient social distancing, where, for example, they could order groceries online without having to actually visit a crowded marketplace. And for merchants, it has demonstrated the business continuity that it can provide. A good example is from the cable TV industry, where a large number of small cable operators did not have any digital payments infrastructure, and hence their revenues suffered very seriously because they could not go home to collect cash payments as usual. Uh, sure enough, in the month of May, so data for the month of May is only available currently for the NPCI platforms. So here I've plotted AEPS, RuPay and UPI, where we see a recovery. And in the case of AEPS, AEPS transactions are actually doing better than they ever did before the pandemic. So these transactions have recovered. It remains to be seen whether the value of transactions on credit card and debit card will also show a similar V-shaped trajectory. Although we must be mindful that transactions on UPI, AEPS, or RuPay um, are generally for purchasing essential goods and services, and hence these are low value transactions, whereas transactions on credit cards and debit cards might be to purchase high value services, for example air travel or hotel stays, which might be subdued for a little while. And another caveat here is that AEPS transactions are mostly related. In fact, the ones that I've plotted here are all related to cash withdrawals. So that, of course, should be we should incorporate that risk averse flight to cash here again when we interpret these trends. Finally, due to the different socioeconomic context in which different instruments are used in India and the demographic profile of the users who use different instruments, the average transaction value differs. So here I've tabulated the average transaction value for the month of April 2020 for different instruments, and also the cost to the merchants and subsequently to the users of incurring these transactions also differs. So here, for example, in the last two columns, I've included the merchant discount rates, which is the share of the transaction value that a merchant has to pay to their bank for providing them the necessary infrastructure such as the POS terminal to be able to accept digital payments from their customers. And we see a variation over in the MDR rates, in the merchant discount rates across instruments. And I've also calculated in the last column hypothetical MDR at 1% to show that if there was such a transaction cost associated with different instruments, what would be the magnitude of such a fee. That's all from me. Thank you, and I look forward to hearing the panel's views and placing these trends in greater context.
Thank you, Shivangi. That was very instructive. And I think one of the key takeaways from this is that we are looking at a pretty heterogeneous market, which is the case in India. You know, the duality between Bharat and India is very clear in the market dynamics as well. And I hope that we will get to that soon as we go through the panel. Sunil, I wanted to start with you, not just because you're a professor who is used to framing debates, but because you were sitting out of Europe, which is also now looked at as some sort of a beacon of regulatory legal trends for decision makers sitting in India, for academics and think tankers sitting in India. And the question I want to pose to you to begin is this, that it's clear that the digital economy is going to increasingly rely on services and platforms that offer multiple functions and multiple value additions to a consumer or a business. And this is evidenced by the fact that 7 out of the 8 largest digital platforms, companies, services, in terms of market capitalization are multifunctional platforms. And by the way, they happen to be based out of either the US or China and not Europe, which is, like I said, looked at as some sort of a touchstone for regulatory trends. So I wanted you to place this in context for India, because obviously digital payments is a fast moving market where innovation is happening at a breakneck speed. It is also one of the bright spots in terms of inward FDI and generally market activity associated with mergers, acquisitions, and so on. So given that innovation is central to this marketplace, how should we view the regulatory constructs that we put on it? And there are two that come to mind immediately for most scholars of regulation, which is either a principles-based approach, for which you need a large amount of state capacity to be able to move towards a particular goal. And the other is a rules-based approach, which we seem to be following, or the RBI certainly seems to be following to the T, which is to basically take a more a finer approach towards every rule or regulatory change to identify the market participants affected by it and the change required very precisely. So Sunil, over to you for your initial remarks. Sunil, you'll have to unmute.
Sorry. Thank you, Vivan, for that question. And I should also remember to thank Samir and all other colleagues at ORF for giving me this opportunity to share some thoughts here. Before I get started, I should give some context. I'm not really an expert on the question of digital payments. I got here through a couple of routes. The most recent route, of course, is that I was looking more closely, since for quite some time now I've been studying the India stack. I was looking more closely at the cashless layer and trying to think about the UPI as an international best practice for other countries to adopt from the Indian context. And as an example of where a central bank might decide through a new vehicle, perhaps, to play an operational role in the digital payments ecosystem. And as I was writing this article, many things began to surprise me, and I learned many things, and I think this meeting is an opportunity to share some of those things. The second route, of course, is maybe 3 years ago, my partner was defrauded using her debit card, and we lost quite a bit of money. And I, at that time, really admired the programmer that wrote the script, because it happened in such an organized fashion, each deduction from her account. It was magical how the whole thing happened. But of course, what was not magical was trying to get redress. And we actually failed, even though we are rather competent people, I think, when it comes to understanding finance and internet technologies. We weren't able to get the money back. So even 2 years ago, when UPI 2.0 was launched, there was this promise that recurring payments would be enabled by the new version of UPI, and the standard would basically allow for it. And as we have thought and imagined, or as you sort of suggested, one way to frame this and one way to understand these developments and why recurring payments has not happened as frictionlessly as various stakeholders might want it to be, is to look at the big shifts, right? And shift number one has already been identified both by you and by the presentation, which is the shift to the cashless economy. The shift isn't as complete as we hoped it would be, but that's the big shift, the dematerialization of money. And the second big shift over the last decade or so is the shift from the welfare state moving from directly providing goods and services to welfare being direct benefits transfer. And the worry, perhaps, and here I can only guess as somebody observing from outside, maybe the worry for the regulator is that once these regular pattern of direct benefits transfer is noticed in the bank accounts by predatory fintech companies, then these companies might use what is known as surveillance capitalism to push consumption loans without collateral onto the poor. And then because the UPI 2.0 allows for recurring payments without overruling or without consent and so on, this would become India's version of payday loans. Maybe we would call them welfare loans here. So when I think about that side of the story, then I say, yes, maybe we need a paternalistic state, and maybe we need friction, both as a tool of security and as a tool of consumer empowerment. But on the other hand, there are people that might want to make several recurring payments, both small ticket and large size, to a subscription service or to a bank. And therefore, when you were asking in your question about this distinction between principles-based regulation and rules-based regulation, maybe we need a sort of strange synthesis of the both. A rule makes sense only when it applies in a particular context. So if there should be friction, or if we should seek consent, then we should be asking, who are we seeking consent from? Is this 30% of the population that is unlettered, or is this somebody else that is traveling internationally and knows how to use modern technology? So maybe what I'm arguing for is a differential treatment. I don't know whether that means a principle which treats different parties differently, or a rule that treats different parties differently. And we also need to be super sensitive about how we treat people differently, because the statistic about the AEPS doing particularly well is, in a sense, during the time of pandemic, a scary statistic, because those are all biometric contact-based authentications or transactions, and that is exposing so much of the poor to the disease. So again, we need differential rules, but they have to be designed rather carefully, taking into account the needs of different parts of our society. Thank you for this opportunity.
Thank you, Sunil. That was just under 6 minutes. Great template for others to replicate. Malavika, we can turn to you. You have been looking at the bottom of the pyramid in terms of digital transactions and payments for a while now. And you know, when is it that we can expect platforms of to cater to these segments seamlessly? Just the other day, in fact, on Twitter, I found an advertorial, or whatever you call it, an advertisement, which was pushing something called DigiFarm, which seems to be somewhat of a success in Kenya, wherein Vodafone UK and Vodafone South Africa, Vodafone Kenya, tied up to offer credit to small farmers for maize, and they also provide low-cost seeds. So you see a hybridization between credits and essential commodities here, which is very interesting. And they expect that by 2025, they'll increase farmer earnings by $2.35 billion, which is quite significant. And if in India we can enable some of these things through bottom pyramid transactions and services, perhaps we can achieve the 5 trillion target that we've set for ourselves. So Malavika, over to you for your initial thoughts.
Sure. And thank you, Vivan, for having us. And thank you to ORF as well. I mean, again, to set context, my organization has been looking at financial inclusion, and we try and act as a kind of feedback loop between financial regulators and regulation and what's actually happening on the ground to what we actually think of as the mainstream in India. So if I paint a picture of the average Indian today for you, it's actually not people on like all of us on this webinar. Most of us, 70% of our country, we know from the last census is rural, and that's set to grow up, likely because of the migration that we've seen over the last 2 months. Also, like Shivangi mentioned in her presentation, 90% of the small firms in this country are micro enterprises. So our interest as Dvara Research and as the Future Finance Initiative, which I lead, is to understand how can technology help enable and cushion some of these, highly stretched and incredibly intelligent managers of balance sheets. Actually, I think one thing we forget about poor, scarce Indian households is that they have incredibly great balance sheet management skills that I wish sometimes our corporates could also have. But having said that, just to paint a few, give you a few data points from what we've seen in the last 2 months, because quite the reverse, I'm in Mumbai and our organization is very much trying to work with other organizations who are in the eye of the storm. One kind of additional flavor to provide in terms of that flight to cash that you talked about, Shivangi, rather than a risk averseness, what we see is that maybe a lot of this is driven by actually government to consumer cash transfers. And that's set to continue. In this environment, macro and micro, likely you're going to see a lot more consumer spending, and there is going to need for consumer spending and a need for government stimulus to reach micro enterprises and exactly the kinds of consumers who need very, very small ticket cash withdrawals. I think another thing that we are seeing is there are a lot of artificial constraints actually on the usage of digital payments. This is actually, even for all of us, and I, for the last 4 years, have been a kind of consumer protection hawk almost, right? Where it's all about the harms and the kind of predatory loans. And actually those behavioral consumption loans are already here, Sunil, as you know, for the last sort of 6 years, they've been here. So you give someone a loan upfront, you track their behavior, and then you use the good kind of repairs. What happens then is that those who don't take the loan seriously have a bad credit score and potentially are shut out of the credit system. This is the kind of thing I might have talked about last year, but this year really I think the important thing to think about is how do we open up channels of digital infrastructure and payments so that more people can use contactless and cashless system in a kind of a situation where we are in a pandemic. And so there I would say the artificial constraints, and in the very limited time I have left, I would like to put 3 kind of buckets of issues before you, and I'm keen to hear solutions from a much more connected and I think influential audience than the current speaker. I think the first one is we have seen things like server capacity, for instance, especially for APS. So again, in March, APS transaction volumes until March were classically around 170 million or so. We've seen it go up to 403 million transactions in April, and in May it's 405. And I think what's great is that the RBI has gone into daily release of payment statistics from this month. So we should be able to track that. But one thing that has let consumers down is failed transaction, which I'd love to talk more about. We have a policy brief that actually crunches the response codes of failed transactions from 4 providers in India, which is unfortunately showing failure rates, which is not reported, unfortunately. Failure rates of roughly 40%, ranging from 10 to 62% of transactions failing when consumers try. And the major reasons for these failures, for instance, is server downtime, biometric mismatch, things outside of the consumer's ability to control. So one is how can we remove these artificial constraints on the market itself? It's good for providers, it's good for consumers. How can we get those bottlenecks out? I think the other thing is also transaction caps. I know this is a very difficult conversation to have, but that's why I want to state it upfront. Many, while we want consumers to use more, systems like APS do have caps on individual transactions. And I understand it's about 20 a month. That's not even 1 transaction a day. Many banks, and these are all not regulatory driven, just to kind of, this is all market driven. And I think it's, very complex. I sympathize with providers who have to run a system which may not have many large returns. But the question is, how can we get more appetite growing from industry to serve volume, right? And not to be looking for those single high value transactions, because the need is there and it's not going away. And government cash transfers are here to stay for the next many months and years. And then the last one, I think, is costs. I'm sure this we will have a lot of discussion around. But how can we avoid externalizing the costs on consumers is one thing I'm obviously keen as a person who thinks about consumer protection. But also, how can we enable pricing of costs and transactions in a way that is more, enables more of this kind of attempt to reach consumers? And I'm sure we'll have a discussion about MDR and interchange fees and switching fees, costs within payment systems that often hold back the usage of digital payments by people in need the most. And I suppose just to kind of wrap up, I think of this in kind of three categories, right? When you have someone in need who's vulnerable, and I think one unfortunate thing that has happened is that in the last 3 months, the cash supply chain has broken down a little bit, right? And that has happened because banks have shut down their branches. Many people still prefer to go into a bank because of a trust factor, which is huge. And then, of course, banking correspondents have also been under risk. So they've also minimized their ability to go into communities. So that's why we often see a shift towards things like APS, because you do have a micro ATM. If you're a migrant walking down a road in a shop, you could stop and get money out of a micro ATM. And that's where, if you're seeing like sort of 60 whatever % transaction failures, how can we reduce that? And think about in three buckets. One is improve acceptance infrastructure, improve ATMs, improve other kinds of points for consumers to get cash, because we live in a, cashless might happen, but right now we're a cash in, cash out points are more suitable for our country, because a migrant worker earning less than 10,000 is not going to be in a cashless loop. So how can we create cash in, cash out networks and acceptance? The second bucket I think about is usage. And that's, I think, a large role for industry. How do you engage the consumer to build trust? Because I think we're very good at stick. Can we get into carrot a little bit? That would be great. And then I think the last section really is to think about redress. And this is something I hope we talk about more. I think winning on redress will improve acceptance and will improve usage. To give you a sense of what happens when a consumer loses money because there's a server downtime or a biometric mismatch, that money can take up to 3 weeks to be refunded into their account. So imagine someone trying to take out that 500 rupees, and that's literally a consumption loan in that it is to eat. If that takes three weeks to come back, when the RBI regulations offer 5 days, they T+5, that's a real tragedy. And I think what is more concern is that sometimes it's never returned because it just sits in a suspense accounts because of how our system is organized, which we can talk in more detail if we want to. My kind of, I suppose, call to action to this panel is how can we quickly put in place a kind of complaints mechanism using the technology that we have to get these feedback loops going so that direct benefit transfers aren't sitting in a suspense account somewhere and they're actually getting dispensed from our digital payments infrastructure. So I think those are kinds of the 3 buckets that I'd love to talk about. And I do have some solutions, but I'll kind of hold them back in the hope that I've beaten Sunil to the limit for our comments. Thank you.
Thank you, Malavika. Ashutosh, if we can turn to you, I think some of the things that Malavika has discussed directly implicate businesses such as yours that globally are driven through market-based regulations in several advanced jurisdictions. And I'll give you 2 examples. One is on this MDR front that Malavika touched on, where today in India, you have 0 MDR for RuPay and UPI, whereas platforms such as yours are allowed to charge MDR. And globally, we see that this is not really a regulated activity. It's up to the market demand and supply dynamics to find the right price. And one would imagine that no private sector entity would like to price itself out of a market that it is catering to, and you would be acutely aware of the fact that you're targeting different segments of consumers. So I just want some inputs there on, should we use MDR as a tool that lifts all, as a rising tide that lifts all boats, or is there some other logic at play here? And also similarly, we have this strange regulatory paradigm that has emerged over the last few months, which is that you are, merchants are not allowed anymore to store details of their own customers and users on file. They have to rely on payment aggregators to do so. And ostensibly, this rule was brought in to ensure privacy and security and so on. But at the same stroke, the rules also refer to merchants having to follow international standards set by PCI DSS, which ensure those very goals. So it's unclear to me why we deviate from international best practice in these two areas. Is it because we are a unique market and we should therefore have an exceptional lens to govern this market, or is it irrational to continue down this road?
Okay, so thanks for that, and yeah, Sunil and Malavika and Shivangi actually set pretty nice context. And to your last point, I won't call it irrational, right? Because I mean, there's always a logic that somebody follows for certain this thing. But let me try and frame this entire conversation, right? And I think Malavika and Sunil also set that tone very correctly. What is it that we're trying to achieve? We do want to become a less cash society, right? We will not become a cashless society. I think that's many years out. But we do want to become a less cash society. But we can't become a less cash society if the entire value chain, right? So whether I'm a migrant worker or whether I'm a businessman, I don't get into the digital commerce entity, right? And those things are going to be predicated on a few very important aspects. One is ease of use, convenience, the choice that I have as a customer or as a merchant to transact digitally, right? And most importantly, the trust and awareness that I have of what are the possibilities in front of me, and the fact that my money will be used for the purpose that it's being used and it not go out of the thing. I think so we need to frame it amongst that entirety. And when I look at it that way, and I look at the changes which have happened over the last 2-3 months, right? And I was listening to another discussion of, I think a few days ago, where we felt that demonetization was a watershed moment for digital transactions in the country, and the pandemic has become another watershed moment. Unfortunately, the pandemic has also driven, or fortunately to a certain extent, has driven a lot of attitudinal change, right? Which has been driven because of fear, the fear of handling cash today. So when I look at the questions that you've asked me and some of the points which Malavika raised, I look at two key segments, the merchants and I look at the consumer. What does the consumer want, or what does the customer want? He or she would like to have access to the ability of his cash, to be able to transact using digital cash or cash, whichever way he looks at it, or he or she looks at it, in any sort of form, in any sort of entity that he's going to interact with, any type of enterprise, whether it's a small kirana shop or it's a large store, right? And he would like to do that in the easiest of fashion, with the best possible choices. So what we need to enable that individual with is to go digital, right? And the points that we need to focus on is, are we making that entire process frictionless for that individual, right? So we talked about, I think so Malavika talked about contactless, right? And I'd like to touch upon that. We've seen that while we've had, over the last, we have roughly around 50 million contactless cards in the country. But before the pandemic hit, or before COVID hit, we had nearly a 4% usage of contactless transactions in the country. That number has moved up to nearly 15%, right? The RBI has come up with a requirement, which it is of course put into abeyance, where every customer needs to opt in for that opportunity. I think that's one of the low-hanging fruits that we need to relook at, that every card should be made automatically enabled for a contactless environment. It's only if an individual decides that you can, and that's at the time of sign up, you can decide whether I want to opt out. That's the first and foremost thing. The second thing is we need to look at how can we easily increase the value of that, the tapless usage from the current 2,000 rupees to maybe a higher limit, 3,000 to 4,000, because that's what customers are, that's how transactions are moving along right now. The other aspect that I'd like to touch upon over here is that when I look at the different types of ways that I can interact to pay, can I look at contactless? Can I look at a single QR code instead of a multitude of QR codes? Because then you're confusing customers, right? And you're confusing them. Can I look at the way of educating my people on, like Malavika said, what should I do when I go wrong? And we have, as Mastercard, we've actually been thinking of something very seriously, which is similar to the telecom industry, where you have a quality of service type of a regime, where the where the TRI comes out with a quality of service measurement. Is there something that we can do like similarly in the payment industry? Come up with a quality of service metrics, right? So that actually then we know how safe and how fast and how easy is it to go through one particular digital commerce transaction. That's at the customer level. The second part is the merchant, right? And very rightly said, most of our merchants are actually there in the hinterlands. They need to get online, and they need to get online in a very simple manner. So we're not talking about merchants making a website, right? Is there a way by which a merchant, and let me take the smallest type of a merchant over here, a neighborhood convenience store or a kirana store shop owner who's been the most active in the last 3-4 months actually, right? Or our street or the telewalas who come with the fruits and vegetables in front of our houses. They have been the most active. Can they at any point of time go digital? Can they quickly get onto the digital bandwagon within 30 minutes, talk about what they have, send the list of their products that they have to the neighborhood that they service, right? Either through an SMS or a WhatsApp or any other messaging this thing. People can order, they can pay online, the money gets into his or her account, and they can deliver the goods. Make it easily and seamless. And at the back end, can we make sure that these fruit vendors or these neighborhood kirana stores can actually also transact with their distributors in an easy way? Now, what happens in the rural areas, right? You cannot have POS terminals everywhere, and that also has a. But you can also, given the level of interaction that we have in terms of the amount of mobile phones or smartphones which are penetrating, right? Let's look at smart POSs coming up. Can we convert those mobile phones into smart POSs? So that's another innovation that you can look at. So when I look at, but then it comes down to this thing that somebody's got to put oil into this machine. Malavika talked about we need to increase acceptance infrastructure. We need to increase education of people. Who does that? It's the banks who do this. It's the payment facilitators who do this. And they will not be able to do that if we make MDR go down to 0. So while MDR may be seen as an obstacle, there are ways to circumvent this. So let's say, can we do a system where all the small kirana shop owners or all those up to a certain level, let's say people who are, whose turnover is up to, let's say 20 lakhs a year, right? For every transaction that they do, let's look at reimbursing their MDR to them. Let's not reimburse MDR to the large organizations or the large multi-brand retail outlets, because they don't need that. They're anyway offering digital payments. So where the issue is, the small kirana shop owner, the small MSMEs, and the users who purchase at 200 rupee or 300 rupees a day, they don't need to be disincentivized. So disincentivize cash usage there, but incentivize digital cash payments over there. And that's, I'll stop there. I mean, there are other solutions, but.
Thank you, Ashutosh. You put a lot of ideas on the table, which we will come back to. Vishal, in a couple of months ago, in January or December last year, the RBI mandated, or the Ministry of Finance actually mandated, that every merchant above 50 crores of turnover needs to have an integrated digital payments provision for its customers. And this is directly linked to a little bit of what Ashutosh was talking about, which is that you have different sizes of businesses in this market. Again, heterogeneity being the underpinning theme. And they have different capacities to be able to service consumers. And one would imagine that 50 crores is also quite a liberal threshold, because businesses of that size, even if you're a 10% of that size, you should have the ability to integrate digital payments that are increasingly cost competitive into your service provision. Be that as it may, my question to you really is around the heterogeneity in the market that you also see vis-a-vis your own consumers, because, you know, whether it's a good or bad thing, a lot of us are dependent on a variety of Microsoft services for email, for cloud storage, and so on and so forth. And you would see, therefore, very different kinds of consumers coming to you and facing different kinds of frictions. So I would just like you to speak to that. You know, how do we take a graded or a proportional approach to some of the regulatory frictions that such consumers experience across the spectrum?
Yeah, so thank you, Vivan, and thank you, everyone. Being one of the last persons to speak has some advantages, and I can, bank upon what others have spoken. A couple of things before even I answer Vivan's question. India in general has been kind of at the forefront of payments, payment technologies. If you think of chip and pin was launched in US just very recently, almost 10 to 12 years ago after India launched it. And it was also with much fanfare. India was also one of the early adopters of the 3DS technologies or the two-factor authentication, which made most of the Indians used to getting one-time passwords, and friction was considered good when it comes to Indian consumers payment, right? I mean that's like a trademark, that if I'm making any transaction, I can expect to have a one-time password, and if I don't get it, then I'm kind of thinking, what happened to my transaction? Is it a fraud, right? And then UPI framework has been a big hit. In fact, Google has published a white paper on that and presented to the US Federal Reserve to make the payments faster as part of the faster payments network. So all in all, India has been significant when it comes to adopting technologies or even coming up with new technologies. However, specifically on the recurring part, the recurring framework, it seems like a bit of a step back than where it was, right? I mean, here we are all talking about advancing digital payments, converting cashless. I mean, when I talk about digital payments, I'm not just thinking about converting cash into digital transactions, but I'm also thinking about converting checks into digital transactions. Many SMEs in India and many corporates still send checks to Microsoft for using their services, to make the payments, and we are trying to turn them into digital transactions, like using credit cards or debit cards. But that the recurring framework is like a step back. To start off, 100% of Microsoft's payments today in India are on the recurring format, right? So all the transactions are coming through as recurring. In fact, 60% of our transactions are about 2,000 rupees, the cap which has been mentioned. The recurring framework, if it's immediately implemented, straight out means that Microsoft has to completely change the business model, or in fact look at alternate ways in which the SMEs can continue to pay Microsoft for their services. As an SME, what I really want is a frictionless payment, because I don't want to get into administrative tasks of initiating payment every month. I have to pay my utility bills. I have to pay my bills of utility services like Microsoft, or my storage services, whether I use OneDrive or Google Drive or any of that sort. So I know I have to make a payment every month, and it doesn't make sense for me to wait for that billing amount to come and pay, wait and initiate a transaction, get a one-time password and all. It's an administrative overhead as an SME owner, or even as someone who's of a little bit small size, a startup who wants to become like a Paytm or a Swiggy, right? So it is adding a lot of friction. The biggest aspect in this whole conversation about recurring framework is there was a representation actually that, okay, let's try and make transactions more recurring. Unfortunately, what happened is credit cards and corporate cards, which were always of recurring nature, which never had cap, which had no mandatory two-factor authentication to start with, they are also now under this ambit. And traditionally, the chargeback rates of these credit cards and corporate cards is extremely low. It's less than 0.1%. And I mean, I'm talking about Microsoft, but maybe Visa and Mastercard will have more aggregated data. So I think, and this also gets on to a qualifier of Sunil's point about how do we differentiate the transactions, right? I mean, debit cards, you understand the customer loses the money on an immediate basis, right? And then, as Malavika said, they may have to wait for 3 weeks until the wrong is undone to them, or maybe it's never undone. But something like a credit card or a corporate card, which is a lot of I mean, it has a big percentage of transactions on recurring framework, on the recurring format. They are, you're not really losing the money immediately. You're losing your credit amount, you're losing your credit balance, but then you have that ability to charge it back in case you're undone, and then you also have the ability to pay it later while the chargeback is still resolved. So keeping credit cards and corporate cards out of this policy of the 2,000 rupees chargeback cap is really a good idea. On the SMEs front, again, having all my transactions on a credit card on a recurring format makes it easier for me to do cost management. Otherwise, I have to remember to pay a bill, send a check to somewhere, send a bank transfer to somewhere else, do a one-time transaction with somewhere else. It's kind of cumbersome. I may lose at least 1 or 2 days in just doing doing this administrative overhead runs. So all in all, we would from a Microsoft perspective, and even as a merchant which represents a lot of other merchants in the APAC region as part of the MAG, the Merchant Advisory Group, it would be really useful and make as a low-hanging fruit to keep credit cards and corporate cards out of the 2,000 rupees threshold, while we even look at increasing that threshold from 2,000 rupees to something else, maybe something higher, which can help the SMEs, the small corporates to make their regular payments on a recurring fashion. The other aspect, specifically from a merchant side on the recurring framework itself, is the e-mandate, right? Today, it has been almost 1 year since August, when the RBI issued the framework, and so far there's only one solution in the market, that too with the payment service provider like BillDesk, who says that the issuers can come onto this platform, the merchants can come onto this platform, and you will be able to comply with the RBI regulation. But that e-mandate is very specific to BillDesk. Someone who's using PayU or Razorpay or any other payment provider, it's very difficult for them to to adopt to that framework. The issuer will have to do multiple integrations. I have a small diagram I can show if time permits, but essentially what is happening is that e-mandate needs to be interoperable. Just like you have UPI, which is interoperable irrespective of who your UPI provider is, the e-mandate, which is generated by the bank for recurring transaction, it has to be interoperable. It should not matter whether I'm charging it using BillDesk, I'm charging it using Wirecard, or I'm charging it using PayU. Now, from a merchant perspective, what happens tomorrow, right? I'm using BillDesk since 3 or 4 years as my payment provider, and suddenly it goes bust. All my recurring transactions and all the e-mandates become invalidated, and I'll be in a big, technical overhead, operational overhead to ensure all these transactions are successful. So I think we definitely need RBI or NPCI or even a consortium of merchants and card networks to come up and release some kind of specs, technical specs, which the payment providers can adopt to. So there is interoperability, there's standardization across the market, and then the ecosystem is not integrating with multiple different solutions for the same framework. So, I mean, and a couple of people have already spoken on the PAPG guidelines about storing of data. Yeah, I mean, that itself, right? I mean, we are talking about recurring transactions and increasing the scope of it, but inability to store card data means that I can no longer do recurring transactions by default, because I would have to rely on my payment provider to do that, who does not have enough customer information like I do about this customer transaction. So all in all, I think the recurring framework itself needs to be relooked at least from a from a scope perspective. Credit cards or corporate cards to be excluded, and also technical specs in order for standardization, interoperability, so that there's no monopolistic solution existing in the market.
Thanks, Vishal. Very pointed recommendations, and we'll come back to you in the second round on some of these. Over to you, Mr. Pai, on your vision for this digital payments market and what the NITI Aayog proposes to do about it.
Thanks so much, Vivan, and it was indeed a pleasure to listen to the other panelists and get his perspective on the space that's becoming increasingly relevant. So very interesting perspective so far. So let me sort of step back a little from digital payments in terms of talking about the infrastructure and the current regulations, and talk very briefly about what the incentives of the government have been so far when they're looking at digital payments. So very broadly, if you look at the government's incentives to start looking at digital payments, the initial part and focus was on what I would call formalization of the economy. And in formalization of the economy, we had some fairly crazy metrics for a country, even with a $2,000 per capita GDP, or $1,700 at that time, of less than 5% of the population filing tax returns and less than 3% or 2% actually paying taxes. So the original sort of motivations of the government were to try and figure out, I would even take it one step further, behind even the tax returns. It is when a very small percentage of your economy is in the formal sector, it becomes extremely difficult to measure your GDP growth, actually provide, the data is limited, it's very difficult to measure what things are growing at. Some areas, a lot of the growth over the past 20 years, people have regarded it as more the informal economy becoming the formal economy, and actually India's growth was significantly lower than what was stated. So there are lots of problems from a data perspective that the country was having, from a revenue perspective the country was having. And then thirdly, if you look at the private credit to GDP ratios in India, they were among the lowest in the G20. Only Saudi Arabia and Indonesia were similar. So we had less than 60% debt to GDP, which tells you it was a vast opportunity out there. So what the government did in this formalization process, we talk about demonetization over the next 24 months. We saw tax returns increase by, I think, almost 80%. When we had GST go into place, we saw tax, the GST filings, the number of entities filing go up by 60% in the next 2 years. So a lot of what was happening was trying to formalize the economy for these three reasons. It's understand the economy better, then you can respond better in terms of policy, in terms of interest rates, things can be far more timely. The second was to stop the revenue leakage. And the third, and very importantly, was to start using credit as a tool to help the economy. Unless you actually have credit scores, you know that people are credit worthy, all of that. So I think a lot of the players that have talked today have talked about tracking transactions, but when the levels of penetration are so low, how do we provide it? So a lot, the analogy I would use for the current context is that we built out sort of the roads, we put the gas stations in, but unless you have vehicles and unless you have gas in the gas stations to fuel the vehicles, all of this that we have done so far, being the most innovative, being upfront, everything else, is actually underutilized. So now the government sort of focus has shifted from just that formalization, where there has been some improvement. It's been a step function, maybe a doubling in formalization, but still a small fraction of the overall economy, I would say, is being measured. So it's still very difficult for us to gauge what exactly is going on. And I think now the approach has shifted from the formalization bit to the financial sort of inclusion bit. And that focus is reflected, in a lot of notes that I'm getting and a lot of initiatives the government is taking. Some of them, I think, have been addressed more in terms of questions rather than answers by other panelists. I think Mr. Sunil Abraham talked about the concerns of people at the bottom of the pyramid actually being cheated or not knowing how to manage, whether it's responsible for us to allow them to start entering a system which they don't know how to control. Will they take on too much unsecured debt, things like that. But so what really enables that at the bottom of the pyramid, and we can discuss some of the incentives over there for the government to have that segment also develop. It's less to do with the revenue, less to do with all of that, but much more in terms of the expenditure side. All the government programs that we have, when we switch them over to direct payments, the amount of leakage that is saved and the ensuring that the benefits that are announced actually go to the right person is huge in terms of, the numbers that we are seeing where we have switched to DBT it is tremendous, the kind of improvement we're seeing there. The other thing about this financial inclusion at the base of the pyramid is that we actually find out there's an incentive for people to sign up and enter the formal economy at the base. So even if you don't get the top of the economy and the middle of the economy, which has a lot of mistrust of the overall system, as people enter at the bottom, you'll start getting much better data as to what's really going on at the bottom of the pyramid. So inclusion and direct benefit transfers as a big sort of driver for that is one way that we can actually identify the people that are being impacted. It's been very useful during this COVID exercise also, and a lot of our sizing exercise data that we get from the mobile phone players, data that they get from from the Jam Trinity also has been useful in sort of figuring out exactly what segment of the society was impacted, how much mobility there's been. So a lot of that data has been very useful. So now we've got to focus out what's going to incentivize the people at the bottom of the pyramid to adopt this and why it won't get misused. And over there, I think the one answer and the low-hanging fruit would be financial literacy. But the question is, who's going to be providing that? You have an agency of the government that has the responsibility, but whether they're taking it sufficiently seriously, there are lots of initiatives there. But what is it going to take to make the people at the bottom of the pyramid and even the middle of the pyramid get comfortable by transacting digitally, not just payments, but a larger part of their financial life? And I think that is an area which requires a lot more work. So at NITI Aayog, we've just recently been mandated a couple of weeks ago by the Prime Minister's office to focus on one such initiative to start ensuring that the financial literacy improves in the country, but more broadly, to use the infrastructure and the pipelines that India has built over the past 5 to 10 years, this huge infrastructure where India is a leader, to actually take this and showcase it around the world, as well as give Indian vendors an opportunity to operate everywhere else. And that is an institution called CADFI, the Center for Advancement of Digital Financial Inclusion. So it's a center that is going to be centered here at NITI Aayog and incubated here for a couple of years before it moves out. Exactly the way UAIDI for identity was, many years ago within the same, a previous avatar of this organization. So that's the way we're thinking about the financial inclusion bit. The incentives are, of course, not just the government programs, but the moment you start making the bottom of the pyramid, identifiable, being able to track their well-being, all of that, at a state at which we still have a lot of poverty in this country, and I don't think COVID is going to send a lot more people into financial distress. The kind of enablement it gives the government to identify, help, and interact with these folks is phenomenal. If we do have a track record and everything is centralized. Right now, the benefits are coming even today from so many different places that it's tough to be very fair. There are people that are getting, in kind still from the public distribution system, people getting cash from various sources. But once you have it all centralized and integrated, there would be an ability to see for each family that it's far fairer and more equitable at the base.
So there has been this shift in the incentives for the government to be driving greater digital penetration in the financial sector. And financial inclusion is, of course, now the primary focus, I would say, for the government out of those. But the previous infrastructure that's been laid out is all of that to ensure that the actual goals are met. The work, a lot of that infrastructure is laid out, but we still have fairly low penetration. GST was supposed to, I think someone mentioned that demonetization was a big catalyst and then COVID should be. But I would say that GST is also, something that has incentivized people to formalize, otherwise they miss out on getting the refund. So there is tremendous formalization that is going on in the economy, partially because of these initiatives of the government. And I think the incentives of the government, I think if they are better understood, then, I think plans in the marketplace can be oriented towards fitting with policies rather than sort of requiring too many changes in policies when they're not necessary. There are many, I wouldn't say that there aren't too many obstructions and over-regulation within the most spaces in India across the regulatory regime. But once you align and you ensure that incentives align both with the government and the marketplace, I think we can make much, much faster progress in ensuring digital transactions increasing faster. So I think I'll end with that and listen to more of the dialogue, but I'm learning quite a bit.
Thank you, Mr. Pai, and thank you also for telling us about this new initiative. Exciting times at NITI Aayog. We look forward to the development of this center, and I'm sure all of us will have opportunities to contribute to it in some way. Sunil, if I can now turn to every participant actually, and since we have about 22 minutes left, these will be sharper, quicker remarks than the opening remarks, and I'll come to you on some of what you've said and try to tease out what the solutions really are or how we should conceptually or practically think about some of the things that you've said. So Sunil, if I can start with you, we've heard this threshold number of rupees 2,000 being talked about quite a bit in the context of recurring payments. And it occurs to me that if the pandemic plays out as most observers see, you're going to have a very slow recovery of per capita income globally, and particularly in emerging and developing markets. So it may take up to 5 years for the global per capita incomes to recover to 2019 levels, according to people like Kenneth Rogoff, who's Harvard economist. So now in that context, if we look at thresholds like 2000, does it mean that in 2025 we continue to have that threshold, or do we actually reduce it if it has to keep step with the per capita income and the conceptualization of liability and risk in this ecosystem? But or do we rely on constructs like consent, which we are in the case of, say, contactless and e-commerce payments, where when you're issued new cards, now you have to opt in to make such payments as a user. So on the one hand, we are using a consent-based framework for enabling some of these payments through a security lens. But on the other, we don't really have the ability to give our consent for payments that exceed, say, rupees 2,000, or that, or in fact, even for our merchants to store our details on file so that we don't have to fill them up, or they don't have to rely on payments aggregators that are not interoperable. So any thoughts on all of this, the triad between consent and liability, and one more that Mr. Pai has added into the mix, which is literacy. How do we think about this?
Thanks, Vivaan. Again, I must start by confessing that I don't know enough about this. Malavika, for instance, has studied this for so many years, and somebody like Shivangi is looking at the numbers much more closely. But I'd like to use some of the points Malavika made as a jumping point so that I can get to the question on consent and whether basing everything on consent is actually the right strategy. So the point Malavika made about failed transactions and the disclosure of transaction codes and so on, I think that's a very, very important question. And it's a sort of question that is connected to building trust in the whole ecosystem across stakeholders, including customers. So it starts off with the UPI 2.0 standard itself. Unlike with the BBPS standard, where NPCI published the full standard completely transparently with all the technical details available so that all competitors are on equal playing field. UPI standards are still not sort of broadly available. I don't know for sure whether all the participating banks have the complete standard. The moment a standard is made truly open in that fashion, then parties could be asked, as Malavika proposes, to publish the transaction logs onto some kind of RegTech portal. And then Malavika should forgive my naiveness when I try and imagine a fictitious world. What if the very same portal is also used by consumers to complain and say that my problems have not been redressed and so on? So then, based on certain rules, carrots and sticks can be automatically doled out in an agile fashion by the regulator. And this, in a sense, connects to the point that Ashutosh made, which is quality of service then is sort of measured through regulatory transparency processes. In such a context, consent becomes less of a dependency, and we can start to roll back the dependency on consent when all stakeholders have this kind of transparency. And then going to Mr. Pai's point on financial literacy, again, a very small fix for the regulator is to require payment service providers to provide literacy within the app. So in-app education is something that is very small, but just like labeling on cigarette packets, if there are some requirements that some minimum in-app education should be done, it's a little bit of friction, but it will have huge outcomes. Sorry for taking so long, Vivan.
Thank you, Sunil. That's all very useful, and I'm glad that you've pointed to specific things that can be done fairly easily, like the last suggestion. Malavika, if I can turn to you to just elaborate on some of the low-hanging fruits that you touched on, including reporting, grievances, and redressal processes, and how you would like for them to improve.
Sure. Obviously, this is a very complex topic, but in the interest of time, let me focus on one particular maybe illustration, which helps us see how we can get to better redress quickly. Now, if we look at the chargeback process, I think this came up in Vishal's comments. Now, the chargeback process for things like UPI or even someone like Uber who's trying to capture market in the early days of Paytm was immediate, right? So that really built trust because the consumer was working on a liability framework not imposed by the market, where the issuer said, you use my platform, you have an unauthorized transaction, I put you back in the money. It's not externalized on you. Now, this is how digital payments grew in the US, because the regulatory diktat in the US, so-called regulation light, was that it's 100% bank liability, for limited liability for unauthorized transactions, unauthorized. We have a similar circular in India, and it's slowly moving, but I think that's a quick fix to show how easy redress does not mean building a very arduous process. Background fixes like this will fix the consumer front end of finance. Now, if I give you a comparison with the AEPS, which I care about, grievance redress process, if your money is lost in a transaction failure, which I'm happy to share the link to the analysis we've done. This is not, across the ecosystem, we would love to have those response codes like Sunil was talking about, but we have to do it one-to-one. Now, in that situation, when you lose money, you need to physically go to a bank because a complainant cannot go into the redress process. We have a different redress process from APS than UPI. Then in the bank, someone in the bank needs to take up the complaint for you with the issuer bank, with the acquirer bank. And then that chargeback process has to be initiated. Now, in this kind of situation, it's very hard for a consumer to go into a bank. They have to make a written complaint, and then they have to get that initiated by the issuer bank. Even if the issuer bank gets the money back, we hear that many of them don't credit it into the consumer account, because then they get the money back as a bulk settlement. They need to settle it, and the consumer has no visibility of this entire process. Now, it's not difficult to get from point A to point B, and I'd like to just quickly pick up on a few things that have come up. For instance, if we wanted to get to point A, which is, banks and everybody is just giving consumers trust by doing quick grievance redress. We have lots of models in the US, for instance, in Malaysia, in a lot of Southeast Asian countries, where you're actually able to use complaints as a way to radar for a regulator who is kind of the bad apple. So one easy requirement, even if we didn't change nothing, is in-app complaints, or in my world, physically the banking correspondent, or it's a lot of our digital payments use is assisted tech. That's the reality of India, right? People go and say, please help me, to the person at the Airtel shop to make a digital payment. If we can just have a situation where organically BCs are doing this, business banking correspondents are doing this, we know that, but they're just doing it because of the human element. If right there, it could be as easy to make a complaint when your transaction fails as it is to make that transaction. That's a quick and easy fix that we could start doing right now. And that could help the regulator or whoever is in charge to see where those complaints are coming from and move in to fix them. I think this also goes into literacy. The evidence, sir, shows that many of the literacy programs, even for tertiary level educated, people in advanced economies, there's just a cognitive limitation when you're hit with 100 pages of disclosure. So in the financial sector, we've seen disclosure-based strategies often fail. So while I agree that it is important to have that literacy element, can we use these interactions to build that literacy, right? Can we use this teaching moment between the provider and the consumer to say, you could complain now, right? And that, I think, could be a great way to generate data, which is less of a cognitive load on a consumer, say, who is, probably trying to make a journey home and is trying to access cash and has been shut out. So I think there maybe consent and literacy should be built into the flow of the process, and assisted technology, I think, becomes very important. Again, could carry on, but in India itself, we do have a blueprint for something called a financial redress agency, which we wanted to have as a unified front end for complaints, which came out. I think we have a blueprint for that, which is, this is the institutional fix, right, with Vishal, which you don't want me to talk about. But in the future, I would love to see that come back to life. I do think that there are some windows coming up. We could have a data protection authority. They could take complaints. The Consumer Protection Act just went through Parliament, which allows for the setting up of a CCPA, Consumer Central Protection Authority. That could take complaints. So it's a very quick fix. We have such great UX designers. Can we start taking complaints quickly? And can we use that to resolve redress through a bigger liability framework? Again, a quick circular from the RBI tomorrow could really help us. But I'm sure, any kind of nudges from other organizations like NITI could also really help the situation. So thank you.
Thank you, Malavika. Ashutosh, the questions are getting harder as the remarks get more and more instructive. So how would you look at, the proposition of quality of service is an intriguing one for the payments ecosystem and is analogous to what we see in the telecom ecosystem. Albeit there are problems that persist despite a QoS framework in the telecom ecosystem. So what is the way for us to resolve some of these dichotomies between, say, the supervisory institutions wanting a greater amount of consumer protection and consumer welfare with the innovation outcomes that players such as you may want in this market through a QoS framework? Does it help reconcile some of this, or does it make things harder?
So I think, yeah, you're right. The questions become harder, the issues become complex. But I think so the best way to address all these complex situations is to actually make them, the solutions very, very simple. Right? And the reason why I'm saying that is because we need to understand that a large population which has still not adopted digital commerce, and I'm using digital commerce in the largest sense, is actually there in the rural areas. It's actually those who are possibly above 65, 70, people like my dad, right? That age, and we have to look at that lowest common denominator. So the simpler we make these things, the better it is, right? To address all types of the segments. Now, I think the quality of service angle will actually help us resolve a lot of issues, because and it depends on how far we stretch that band, right? Quality of service is not just how fast your transaction goes through. Quality of service is not just how fast you get a redressal in place, right? Quality of service can also mean how quickly you can ensure, right, that when the money has come into my account, it's gone to the other account. The way the flow has happened in the system, right? So there is wrong usage, there is slippages in the system, there is speed of access, right, and ease of use. Quality of service can actually address all of these. Now, the minute we put that front and center, and we put that front and center for the consumer, for the merchant, for the supply chain, right? And I'm bringing a new concept here because I was looking at some of the questions which are coming in, right? And I think the fact is that we need to make sure that the entire supply chain is also digitized. If we can put quality of service at the centerpiece of it all, with that goal that things need to become easy, they need to be convenient, and they need to be simple for people to address, then we will address the issues between how far or how deep should the regulator go to control, right? How much can an organization like ours, or forget our organization, even the small startups like Cincy or MPAs or whoever they are, right, can innovate so that they do drive simpler onboarding, right? How can we ensure effective education? Because I think what Mr. Pai said, it's extremely important. Financial literacy is going to be the pivot for this entire movement, right? And it has to be financial literacy from the perspective of what can I do with digital payments, right? It's not just, this is what digital payments is. So for that Kirana shop owner, it should be, how easy is it for me to get onboarded? How easy is it for me to accept payments? How easy is it for me to address my supply chain? But at the center of it all, to answer your question, I think the quality of service, if created well, right? And again, I'm not talking about a 120 question quality of service document, because that won't work. It won't fly. It has to be simple, succinct, addressing the main issues, owned by most probably the regulator, right? With a proper redressal system in place. I think we will, if we function towards that as the bull pulpit, we actually have got a solution in our hands.
Thank you. Vishal, if I can turn to you. This supply chain element has come up frequently now in this conversation, and I think you sit amidst many supply chains. And Mr. Anivar Arvind has also asked a question about how we're looking at this entire B2B space and how small merchants are expected to survive in the context of the various disruptions we've seen linked to COVID. So any recommendations that you have, you made specific recommendations on corporate cards, on interoperable e-mandates, on increasing the recurring payments threshold. Those are noted, but anything else you need to add on the supply chain and how we're to make sure that every participant is on an even playing field, because obviously there are unintended consequences of most rules, and particularly in fast-moving spaces such as digital payments.
Yeah, and I think most of the panelists hit it at the head, right? So because India is such a large country, and I'd like to go back to what Sunil mentioned is the differentiation of the rules and its applicability seems to be like a good start when we talk about any aspect. A very easy example I can give is especially on the B2B side, right? I mean, B2B side might have an easier solve compared to something else. Like, for example, there could be a specific, both Mastercard and Visa have new platforms where you can send payments through their systems. There could be specific solutions which the industry can come out with. However, for the industry-specific solutions which are derived specifically on the B2B side, the rules which apply on B2C would kind of become a big friction to continue as continue operationally. Specifically talking about the recurring thresholds and also multiple two-factor authentications, etc. So that ability and the freedom to give a B2B company or B2B transaction to keep them out of regulation, at least to a large extent, would help serve the purpose in many aspects. And that's how, at least at the beginning, you could differentiate a section of the population which would want seamless and frictionless payments versus a section of the population where we would want to ensure that they are cushioned from the side effects of fast and sudden growth in digital payments. So, I think that differentiation aspect is very key. And I'd like to give an example of an Australian regulation which has recently come up, which is very, very significant as well, because there's a regulation that your number of, as a merchant, your number of fraudulent transactions cannot exceed a particular percentage. And they accept that it's not a one-size-fits-all. So, after review of the system, they were able to make changes and differentiate the transactions between B2B, B2C. In fact, if you think of MCCs or merchant category codes, which Visa and Mastercard have, that could be another form of differentiation. That okay, if it's an airline or a travel transaction, which is not possible today, but an airline or travel transaction, that could have different rules, right? You could have MCC specific rules for transactions which are where most of them are on the bottom of the pyramid kind of population. So there are existing systems available in the industry already, which can be utilized to address that differentiation of rules applicability, so that for the benefit of one part of the population, the other part is not impacted.
Thank you, Vishal. And lastly, Mr. Pai, I'll turn to you with an audience question from Mr. Sanjeev Sharma, who says that besides digital payments, we have among the lowest penetration of financial products like insurance, life and health, and mutual funds and loans. He makes a good point. While we focus on digital payments, does the NITI Aayog, through this new initiative, plan to focus on a broader suite of products for financial inclusion? And obviously, all of those would be linked at the B2B level as well with the payments ecosystem. So how do you see that evolving and the role of your institution?
So I think that in September of 2018, when I actually was asked to start and head the banking, insurance, and financial services vertical at NITI Aayog, from that point onwards, we knew what the agenda was, that the amount of penetration of these products was extremely low, and we needed to figure out how to help with these products. So I think that's already been a huge priority for both the government as well as the NITI Aayog all this while. And we have been doing a lot of work on that. We've seen some massive programs like the Ayushman Bharat. We've seen many other programs that we've been trying to focus on going top down and bottom up. Top down, the market itself has a price elasticity. There's this penetration. There's as the economy formalizes, that happens. And then bottom up, for the people that are at the below the poverty line as well as close to it, we have these government programs. So there is a missing middle right now in the middle, which is attractive. The government has to work on from the bottom, and then you have all commercial enterprises focusing on sort of penetrating that massive. It is a massive market out there. And so there are initiatives like CADFI, I think, is more focused on the bottom up for the financial inclusion, giving them these products, all of that. So at least the initial focus is ensuring that government programs, will function okay, that the DBT happens effectively, leakage is reduced. So it's more on the expenditure side, on the benefit side, all of that. But the top down has been happening. So we've been working on aligning regulations. I think, Raghavan, you and I have talked about various policy measures that can be taken to start accelerating, insurance penetration, credit penetration, so many of these things. So that's an ongoing focus for my entire team. There's a whole bunch of us trying to figure out how, what we can do there. So always open to suggestions and constantly pushing in to help make things happen faster. And we've had good progress, but clearly COVID is not helping. And a lot of the work of the one point I would say is that a lot of the work on formalization of the economy would have had tremendous benefits starting at the 3-year mark of actually these higher returns
and GST. But it's really unfortunate when that data was coming and we are getting, a 3-year track record data, the credit scoring, the bureaus, we're beginning to provide decent data. We've actually had an economic event where things have declined so sharply that data is not going to look good even if you have the right length. So it is a fairly significant setback to the Indian economy, that formalization that could have had huge benefits right now. Once you have a 3-year track record of regular payment, all of that credit, I was talking about the gas. You've taught people, you've got people cars, you've built the roads, you've got the gas stations. Now you just need to have, teaching people how to drive the car and, fill them up with gas. And right at that point, we've had, some fairly significant hiccups now. I wouldn't underestimate the tremendous work that's been done these past 3-4 years in the direction of that work. But also recognize that even if you have a track record, but it's a bad track record because you just missed your last 3 payments, it's going to delay everything we wanted by 18 months or so, I would think.
Thank you, Mr. Pai, as always, for that grounded macro perspective within which we want to situate all of our recommendations to government. Thank you also to our audience, which I can see there has been a steady attrition from the beginning to now lunchtime that we have entered. And unfortunately, we can't eat digital lunches just yet. So we should all peel off. But thank you all for participating in this seminar today. And we hope to keep doing this in regular intervals. Thank you.